Hello, everyone. This is Nick Katko from BMA, and I'm joined by Mike DeLuca, who's just logging on. So give him a minute to get all. There you are. Okay, so first thing I want to do is to do the attendance, not the attendance check, do the technical check. So 3 questions, and you can put a response in the question pane. Can you see the presentation? Can you hear us? And can you see us? And so if a couple people could respond. All right. Looks like everything is working. In the past, I have done an entire webinar where one of the 3 things wasn't working. So that's why we do this check. All right. So a few more administrative items. If you have want a copy of the presentation, it is in the handout section of your control panel. If you're watching a recording of the video of this webinar, please email me and I'll be glad to send you a presentation. And if you forget to I can also send it again. And then finally, load your questions as we go, and we'll probably right around every attendance check, we'll take a look at the questions and possibly answer them as we go rather than hold them until the end. We found that to be a little bit more effective. And the final housekeeping item is continuing education credit. If you're a certified public accountant in the United States, you can get 1 hour of free continuing education. For this webinar, if you attend the live webinar, you're logged in for 50 minutes and you respond to the 3 attendance check questions. And if you're not a certified public accountant and you still like some certificate of attendance, just send me an email. I'll be glad to send that along to you. All right, so today we're going to be talking about managing costs with a value stream income statement. So there's 3 basic agenda items and learning objectives. One is to understand and be able to explain the purpose of a value stream income statement. How is it used in lean companies? Second, what are the value stream costing practices that are employed on value stream income statements? And third, how do we use lean practices and a value stream income statement to manage costs in a lean company? Then we'll do the wrap up and take any questions at the end. Hold on, okay, hold on 1 second. Oh, thank you, Mike. I didn't realize I was not sharing my screen. All right, everybody can see my screen. That's why it's always good to have 2 people on a webinar rather than 1 person. All right, so I'll get started and then do a few slides, turn it over to Mike, and we'll just also join each other's discussions. All right, so let's review, what is a value stream income statement? What's important to understand here, if you think about lean companies and value streams, you've probably heard about this. Value streams are an essential element of a lean organization in terms of organizing by value stream, planning by value stream, managing by value stream. The idea behind value streams is these are the sequence, this is the sequence of steps that deliver values to our customers. So from a finance and accounting viewpoint, value streams are your profit centers. They drive revenue. And what we want to do is we want to understand value stream profitability, because if you think about it, value streams are like separate business units within a company, and they might have different customers, different products, different services, different problems and issues, different resources. So we look at value streams horizontally rather than the vertical organization. So therefore, we want to align internal reporting the same way. Value stream income statements also are known as plain English income statements, and they're an internal document for analytical purposes. Okay, when you hear the phrase income statement, you know, the immediate thinking is for financial reporting purposes, but a value stream income statement is internal. Okay, it's used by management for analysis and decision making. The idea is it's a simpler, more usable presentation for internal users. Those are the customers of a value stream income statement, because they're trying to really understand the true cause and effect. Okay, what we're trying to do is we're trying to improve value stream profitability. So we need to understand what's driving the costs in value streams. Now, here's sort of the way to think. You know, if you want to improve your overall financial position of the company, for example, you know, the financial statements that are being reported, focus on the value stream income statements, and then as a result, you will improve your you will improve the profitability that is being reported externally. And it's important to understand we're not talking about a second set of books or a different system of accounting. All the numbers on a value stream income statement come out of the general ledger of the company. So here's a simple example of value stream income statement. We have 3 value streams where we have motors, systems, and spare parts. We can identify the revenue for each value stream. We can look at the actual costs of each of these value streams. Any costs which are not direct or really operational, we keep them separate. We're driving actual operating profit. Think about that. That's what we want to understand. Okay, so what was the revenue for the reporting period? What were the actual costs for the reporting period? And we try to segregate any type of allocations or that are required for any type of reporting purposes. So that's what a value stream income statement looks like. It's horizontal. You know, what's the real purpose? It's to understand the true cause and effect relationships between operating performance and actual costs. That's why we don't want to, that's why we want to avoid allocations and things like that, because they're not actual. This is think of a value stream income statement as a learning tool. Okay, if you want to improve financial performance, even just understand costs better, you have to understand operations. Operations must change. The operating practices of a value stream must change in order to change cost performance, cause and effect, and that's really what's important for everyone to understand. Now, this is the opposite of what I call sort of top-down financial engineering, where, you know, leaders of the company and or financial leaders set very specific cost targets. Costs must go down, and you sort of try to make it happen. All right, so before we do the attendance check, Mike, anything you want to add so far?
No, I think that I think we'll probably re-emphasize some of these points as we get into the next section. So let's go ahead and do the attendance check.
All right. So now let me open up the polling question. All right. And I have to launch it. So I'll give you about 30 seconds. And while we're doing that, I'm going to check any questions. No questions so far. People just told me that I didn't have my screen turned on. All right, I'm going to close the poll. We're not going to share the results at this point. And I will turn it over to Mike.
Great, thanks. So I want to ground this next section in two of the points you just made, Nick. One of them is that we're not creating a second set of books. This is important to understand because as we talk through this, it might seem like we're advocating for some analytical approach that is very divergent from what our core financial systems are recording and telling us, and that's just not the case. But with that as background, the second point that I wanted to emphasize as we get into these the practices we're going to discuss here for categorizing costs is everything that we're doing in lean financial management is intended to improve the organization's ability to understand performance and take action or make decisions, or both. So let's go ahead and look at practices to categorize costs, again with this intention in mind. How are we understanding performance so that we can take action to improve, like Nick, you already said, and make decisions? So as we do this, what we want to think about is, first of all, can we show actual costs, direct costs for the reporting period? Many cost systems or financial reporting systems will collect costs from various periods and report them in a current statement. But again, what we're trying to do is make as visible, as tangible as possible to the people who actually run and manage the operations, what is actually happening in the current period. And when we collect costs from various different reporting periods, what we may be doing is clouding the ability for that manager to say what just happened in the most reporting period. And we want to, in the second point here, we want to really look at direct costs rather than shared costs. And so I'm going to actually spend just a minute on this, that when we say direct costs, what we're talking about is for the manager or the leader who is responsible for production in the cell. And this could be manufacturing. My background is in healthcare, so we could be talking about a clinic or a nursing unit. But we want the manager of that service to understand directly what are they consuming, influencing, directing, using as far as people resources and other resources. And we say rather than shared costs, but what I would add to this is that the people who are managing the shared costs are the ones who are looking at those as their direct costs. So it's not that we're advocating that shared costs are ignored, it's that we're advocating that we have visibility to cost performance and cost behavior most closely to those people who actually can influence changes and improvements. So we want to look at direct actual costs. We also want to, and we're going to talk more about this as we get further into it, especially as we're talking about labor, separating variable costs from fixed costs. I think, coming from if we think about what our educational background, many of us in finance and accounting, and what we learned about variable and fixed costs, what I learned over many years in applied experience in organizations is that many more costs behave as fixed. then we would assume are variable. So we'll give some examples of that, like I said, especially as you get into labor costs. And then as much as possible, eliminate allocations or segregate them, pull them aside. And again, it's not that we want to eliminate visibility to the things that are driving the bottom line P&L performance, but we want to separate those so that the people who truly need to control and improve those have visibility to them uniquely and discreetly. So as we go forward here, when the direct costs that we're going to talk more specifically about segregating and looking at separately, and also thinking about whether they're fixed or variable, we're going to look at labor, materials, machine and equipment costs, and other direct costs. And so we'll talk, whoops, let me get back to the screen here. Let's go ahead and go to the next slide. Okay, good. So let's, like I said, we're going to talk more about variable and fixed costs. And I would say, you know, when I started off in finance early on, we considered, for example, in a hospital, we considered that the cost of nurses was variable based on some short-term volume change. So more patients are in the hospital, you incur more nursing costs. Fewer patients in the hospital, less. It was the same thing with, it could be very much the same thing in manufacturing. And what we experienced or learned over time was that actually you needed to have a significant volume change to have a change in the staffing level. It's not that every single patient drove one more or one less, or some more or some less nursing expense. And so I would think about that, please suggest that you think about that in your own services. If you're running a manufacturing line, and also, you know, my dad was a quality engineer for General Motors, so I got to see a lot of the automotive manufacturing as a kid, because I'd go with dad to work, which was an awful lot of fun and very educational, even though I had no idea I'd be working with concepts like that later in my career. But the line, you know, within certain parameters, that manufacturing line could go at a slightly different rate based on customer demand. You could have somewhat more or less cars, again, within a range. And then once demand exceeded the safe operating capacity of that line, then you'd add a whole nother shift of production. But within that one shift, that labor cost was largely fixed. And so as we think about variable and fixed costs, I would encourage you to look at your labor cost and ask, is it in the short term, does it behave more fixed than variable? And really your variable costs are the input supplies or the raw materials to either manufacturing your product or producing your service. And so that's really that's the lean thinking. And this was really important for me, again, as we completely redesigned our financial statements to really be aware that more costs behave fixed. Again, in the near term, here are changed more by management decisions than they are influenced by customer volume. So I know we spent a good bit of time on this, but this is an important foundational concept. Nick, you want to add anything to this before we move on?
Yeah, no, I think you explained it very completely. You know, what's key is that this is about changing thinking, because if you have any kind of cost allocation system, a lot of what a cost allocation system does, it's assigning costs to specific objects, whether it's a product or a business unit. You can assign it to anything. And in essence, what it's doing, what a cost allocation system does, it takes fixed costs and assigns them in some variable manner, which is somewhat subjective. And so if managers are using allocated costs sort of to try to manage costs, they think that these are variable costs because they're allocated based on some object. And so this is a big shift in thinking. I was working with, you always hear this from a lot of finance and accounting people, And somebody challenged me recently at a company, it's like, well, all costs are, fixed in the short term and variable in the long term. And that's a broad statement. And if you just think about people or employees, full-time employees, they vary based on management decisions. If your sales volume goes up significantly, you will probably have to hire more people, but that's a management decision. It doesn't go lockstep with volume. So go ahead, keep going, Mike.
So we'll talk about shared costs. And what I mentioned earlier was we want to segregate these, not because we don't want visibility to them, but we want to actually make the costs visible in a way that we can more effectively understand what's driving them and then influence improvement. Right? So shared cost characteristics here, that if we think about our ability, again, to drive improvement, if we make shared costs visible in a unique or a separate way and call them out. And this could be anything from a maintenance team in a manufacturing facility to a sterilization team in a hospital. These are costs that are shared by that entire system, but are also driven by the production activities or the service activities of that business. Then that brings broad visibility into, how could we actually improve our use of this shared maintenance or this shared sterilization or this shared lab or this shared housekeeping service. And so making those visible very clearly, but separated from the direct costs, can help all of the different direct production or service teams that are utilizing that shared service can then work together to understand how to improve that. And also, again, since the leader or the manager who's controlling that is going to potentially be outside of the value stream, we want that reported in a way that is where we're aligning the accountability and with the control. And then in this way, we can identify in aggregate ways to improve the cost, because since more than one or potentially many services or direct production or service cells are sharing these additional services, maintenance, etc., then they'll need to work together to show some cost benefit because of the multiple different demands on these shared services. So I think we're up to the second attendance check.
All right. Yeah. All right, so let me open up that polling question. Here we go. There are no questions thus far, so we can keep going with the presentation. I think as you're doing this, I think what's a shared cost is based on shared resources, and in most companies there are levels of shared resources. And in healthcare, you have the imaging department, which is used by all the different value streams. Okay, that's fine. And so it's just about recognizing. I'm going to close the poll. Not going to share the results. It's really about recognizing that in the presentation, and again, what's the purpose of it? Okay, typically what I talk about when I talk about showing shared costs on a value stream income statement is that you want to, there might be some users who want to see the complete profitability of a particular value stream with the shared costs. That's fine. Okay, so Mike and I will sort of co-present the lean cost management practices. So we've talked about the value stream income statement. We talked about how costs are organized and presented. So now it's a matter of, how do lean practices and value stream income statements sort of work together to drive costs? And, lean does control costs. Teachono, has lots of great quotes that you can find on the internet. I love this one. And I think this is really, I show this quote mainly for accounting and finance people as you're beginning the lean accounting transformation. It's not about how well we can calculate costs. It's about how well we can work together as a company to reduce costs.
Mm-hmm.
So the primary driver of managing costs, okay, is what we call the economics of lean. Continuous improvement, the primary outcome, but not the sole outcome of continuous improvement, is creating capacity or more time. If you eliminate waste, if you eliminate a wasteful activity, you have created more time. And what happened, it's how you apply this created capacity. You can apply it to deliver more value to your customers. In some cases, that can create a competitive advantage and drive revenue growth. You can also apply that capacity to achieve long-term cost reduction. And we're going to give examples of this, but this is the driver, okay? If you think about your labor cost, what the labor expense on your income statement is how much you are paying for a certain amount of capacity. So it's a matter of understanding, and this is where lean practices come in, how that capacity is being used.
Mm-hmm.
You can use that capacity to create value or for other non-value added activities. So how does lean achieve long-term cost reduction? And I specifically use the phrase long-term because lean thinking on cost reduction is a lot different than short-term financial thinking. Two ways that lean achieves cost reduction. One is actual cost savings, where we lower actual spending or investment levels. We don't replace people, okay, that leave voluntarily. We have less inventory. We right-size machines. We have less machines. So you see the numbers on the financial statement.
Mm-hmm.
Less scrap. Then there's the cost avoidance, which means we are not going to incur costs in the future. Okay, and that really gets back to the economics of lean, and we're going to show some examples of this. Anything you wanted to add, Mike, on this?
No, we'll get into the examples as we go.
Yeah, okay. And I think the real key is measuring cost reduction, okay?
Mm-hmm.
And you want to have good lean performance measurements in place. So if you think about at a monthly level or a company level, you would want to look at actual costs as a percentage of sales. So
Right.
It could be actual margin, gross margin, actual contribution margin, or specific expense line items. At the value stream level, you could look at the same, or you could look at actual cost per unit. At the cell level or the daily level, it's hard to get to a cost because it's so deep in the organization, but you want to look at drivers of costs. So for example, overtime percentage, change over time, downtime. Anything to add, Mike?
I think another one of the, and I think it's related to overtime, but another cell measure could be, how many units or of production or of service is an individual employee able to produce? Because if, as that goes up because there's waste in the process, we're more likely to incur overtime. So as we look at overtime, there's another potential sort of functional driver measure underneath that. But these are the things that we're looking for.
Yeah, and the note that I had on my copy of the presentation is, we're trying to measure cost reduction over time. We're not trying to measure or achieve reduction in resources.
Mm-hmm.
Okay. Now, if there's some natural attrition of reducing resources, that's fine. But, and this is one thing that I learned when I was in my first CFO job, and I learned about lean as we went through a lean transformation. The lean leader that we hired, one of the first things he said in his first management meeting, which really sent shivers down the owner's spine, was that no full-time employees are going to be laid off or lose their jobs because of continuous improvement.
Mm-hmm.
And that he explained that was very, very important because, people understand what they sort of understand what eliminating waste means. It means more time. And then the question is, what are we going to do with that time? And the first thing they think about is, well, they're going to try to reduce headcount. So, I mean, that's what's important about cost reduction, especially when it comes to people. And we're going to talk about that in a lot more detail. So if you think about the resources of the company, okay, labor, machine, equipment, pretty much any company, it's a function of your capacity requirements. What drives capacity? It is the level of demand, how much the value stream has to produce in terms of goods or services, and how much waste is in the process. Waste consumes time. And so that's why continuous improvement has a dramatic impact on managing resource costs. So Mike, do you want to add anything to this in terms of general way people think?
I think that's, as we get into the next slide on specific labor cost reductions, I think there's some more specific points to make.
Okay. All right. So I'll let you take the next few slides, Mike.
Sure. And I think, coming back to Nick, what you said about, we're having this conversation to talk about how we manage costs using value stream income statement thinking, right? How do we make costs visible in a way that supports the organization's ability to improve financial results? And I think when we get back to a lot of our discussion, in particular around labor cost, and how we measure it, right? So, and this was early on in my own experience, we would have an improvement event and it would take waste out of employees' process. And so there would be, reduced travel time, reduced motion or transportation waste. There'd be all these wastes that were eliminated in a particular employee or a group of employees' processes. And early on, and many of you may have had this experience, there would be a desire to monetize the time savings by saying, how much does that person make per hour? How many minutes have we saved? Therefore, how much did we save, quote unquote, with this Kaizen or this improvement event? And I really want to encourage you to think a little bit differently about the value, the economic value of having made that improvement. And instead of saying, oh, this person makes 20, 30, however many dollars an hour, we saved 30 minutes. So now we've just saved 10 or $15 an hour times the number of employees in that cell. But you're not going to see anything fall to the bottom line. There's actually no cost savings. By improving productivity, by taking what Nick talked about earlier and saying at a certain level of customer demand, if we take waste out of a process, we're going to create capacity that can only be monetized through a couple of intentional activities. And so as your leadership is saying, oh, we're going to have an improvement project or an improvement event or a Kaizen in a particular area in order to remove waste from the process, I would encourage you, before you even get started as a financial practitioner or leader, to say, great, what are we going to do with the capacity we create? Because that's how I want to think ahead about quantifying the financial impact. Are we creating capacity that we can then use for R&D? Is there pent-up demand? What can we do with that capacity that we've created? So as we look at this particular visual, what value-added activities can we redeploy that capacity to? Is there another cell that is overburdened by an increase in customer demand? And we can actually we might move the people from one cell to another, or one department to another, or retrain them to work in another department, right? So there's both a tactical redeployment, which might be meeting pent-up demand or backlog of customer orders, or there might be a strategic redeployment, which might be a new product or service line. And as we do that, we're controlling labor cost by growing revenue much faster than we're growing labor cost. We may even be holding labor cost flat and growing revenue. So I think that's really, again, I encourage us to not try to monetize time saved by using individual labor hour rates per employee and saying, look, we saved 10 minutes, or, I've seen all kinds of examples and done many of them myself, but to think about it in more of a, what are the financial benefits that we've created, and how do we quantify those?
Yeah, I think that's a great point about monetizing time savings. I've seen it in a lot of larger companies where it's sort of, I mean, they have good lean practices in place, but you have corporate people saying, well, how am I going to understand all this? So we need to see cost savings for improvement events, and it sort of makes the lean people pull their hair out, because they intuitively know that this is what's going on.
Mm-hmm.
And I'm going to put this up so we can continue to talk about this topic.
Yep.
And as you talk, Mike, I just want to, maybe we have some time to do, and I wanted to just encourage people, if you have any questions, as Mike's talking, if you have any specific questions about labor and labor cost reduction, please drop them into the question pane and then we'll address them. So go ahead, Mike.
Super. Okay. So we've started to get into some of these examples, but in the context where we have reduced motion or transportation waste, and we're going to avoid trying to monetize those, the reduction in steps, the reduction in wasteful. There could be a good bit of defect correction or rework that an employee has to do, or a good amount of searching waste. As we look at that, we may actually have some hard dollar savings in a reduction in overtime. In order to complete the customer demand for a shift, or to serve a certain level of customer demand in a service industry, your teams may be incurring overtime that simply goes away. So that's actually a hard dollar savings right away. We may be bringing in temporary contract labor or additional labor in order to either effectively or safely produce the product or service that truly is eliminatable by management decision. We're not laying off employees. We're just saying, oh, we don't need those additional temporary or contract resources. So those can go away, and we can focus on producing this product or service simply with the team that we have on hand. We can avoid replacing individuals now. And so I managed a finance team of 30 people. We didn't have a production or service output or throughput requirement. We did everything that a financial planning and analysis and decision support and accounting team would do. And there's a lot of variability in that work. But what we discovered over time as we were creating capacity is that initially when positions became vacant, we would fill them, and over time, as we created more and more capacity on the team, and we're really successful at redeploying that to higher value added work, analysis, all of the lean accounting and the lean financial management work that we wanted to do, we still were able to, as positions turned over, folks moved to other roles in the organization or moved up in the organization, we were able to choose to not fill positions over time. So you can choose to not replace positions over time as well. This also gives you a good opportunity to look internally at opportunities for staff growth and development, to fill positions internally. Again, you may create capacity in one area, you may have a lack of capacity in another area, and you can either, and folks can change jobs, can retrain, can be redeployed either temporarily or permanently. And again, reducing contract labor, you could insource outsourced positions or operations. So lots of ways to have actual hard dollar savings here, as well as distinguishing that from cost avoidance. So there may be a situation where you redeploy staff. That allows you to generate more revenue. However, your cost structure hasn't changed, right? So we're avoiding adding costs as we expand services by producing more with the same amount. So that's avoiding costs. And this is actually going to be true. I know we're talking about labor now, but the same thing is going to go for machine capacity. The same is going to go for facility footprint. And organizations, including mine, have reduced their need for additional square footage simply by getting waste out of both processes and levels of inventory. So it is really important to distinguish between what's an actual reduction in cost. Overtime just went away. Great, I can see that on the income statement right now, versus I've created capacity and I'm going to see the financial benefit as we generate more revenue. However, I'm not going to see a cost reduction. I'm going to avoid adding costs as customer demand goes up.
Yeah, great. And I think what's key here when it comes to labor cost and people and continuous improvement is that this is very strategic in nature.
Mm-hmm.
And you have to have a plan if you are going to drive improvement, especially if it's organizational wide. Like you said, Mike, your finance team. Okay, we're driving improvement. We're eliminating waste. What are we going to do? You have to be proactive about the planning and what the possibilities are, as opposed to reactive. One example that I had as CFO is, my accounting team. The person who was doing payroll was really, really good and eliminated a whole lot of waste, and really sort of turned payroll into more of a part-time position. And it just so happened that, as that was occurring, the human resource administrator was an older person who was getting ready to retire. So what I got together with the director of human resources and made the suggestion that the payroll person can probably handle the human resource administrative duties also, because there was capacity there. So before the human resource administrator retired, they sort of worked together and co-located to figure it all out. And when the administrator retired, the payroll person was able to take over those duties. So those are examples of what to do, but have a plan, and it has to be very strategic in nature. When it comes to machine costs, what we're trying to do when it comes to machine and equipment is you want to reduce the downtime and the changeover time. You want the machine available. Okay, and again, you're creating more capacity, And much like labor, this is a resource cost. You can apply the capacity to meet demand. You can also right size the machines. You know, if you have a machine that has too much capacity, you can trade it in for a smaller machine. You can also reduce maintenance and repair. Sorry for all those ampersand signs down there. And that's really how you control your costs. And, you know, it's a combination of, I'm sorry, you know, the actual, there's the cost of the machine, and then there's also the cost of the people that run the machine. So again, you create capacity on the machines, you can reduce the overtime expense. If you reduce downtime through sort of total preventative productive maintenance programs, you can reduce replacement part costs. You can reduce, you know, the cost of outside maintenance. If you outsource because you don't have enough capacity, you can probably reduce your outsourcing costs. You can also, like I said, right size machines. And then again, you can avoid hiring operators, you can avoid hiring maintenance people, you can avoid buying new machines. Anything you want to add, Mike, before the final attendance check?
No, and I think actually, so just the one thing that I want to add is, since we don't have, we haven't done explicit slides on it, is please think about your facility capacity the same as your machine capacity. As you improve the use of your physical space, you can really have similar actual savings and costs avoided as well. So just so think about that in a similar way.
Yeah. So let's do attendance check 3. All right, let me close the poll. And let's talk a little bit about material cost reduction. And this is, and when I talk about material, I'm also talking about supplies. So we can be talking about inventory and manufacturing, or in some in like healthcare, supplies are a very large expense. And it's the idea is all the same. If you think about the cost of material, the equation is simple. It's price times quantity. And so what you do is you focus on both sides of the equation. So, you know, if you want to change the purchase price of anything you buy, you know, you can change the part or change the supply. You can get a lower price from your supplier, or you can change suppliers. That's really all you can do. What's important to remember here is not to sort of drive anti-lean behavior. We're just going to go after the lowest prices, because if you need materials or supplies, you want suppliers that provide the best value in terms of quality, delivery, lead time at the lowest cost.
I think one thing to put in here. Go ahead.
No, go ahead. No, I'm sorry.
No, it's just as you're talking about this is, so there's just one additional thing under methods here, because it is maybe implicit, but I want to be explicit that in lean thinking, we're actually trying to reduce the amount of inventory on hand. And that is from the raw materials or input materials through work in process, through finished goods. We're trying to reduce that and minimize it safely as much as possible. When we see lower price from supplier here as a method in conventional systems, oftentimes that means getting larger quantities, because we think, oh, well, I'll get a price break if we order a whole bunch of this. And actually, and we could talk more specifically, please post a question in the question pane if you want to go into this in more detail. But it's important to do both at the same time. We're actually trying to buy smaller lots lots, smaller quantities, more frequently, and still get pricing benefits. And there are ways to do that. So keep going.
Yeah. Yeah. And if you think about the other side of the equation, that was a great lead in, Mike, the quantity of material. Okay. There's three reasons why you have the quantities you have is you have to buy material to ship it. That's going to increase with volume, and that's good.
Mm-hmm.
If it's supplies, you're consuming the supplies very, very quickly. You don't have months of supplies on hand. You can reduce your scrap expense, okay? And that as quality improves, the quantity of material you have to buy will go down because you're reducing scrap. And then, as Mike stated, how much material do we stock?
Mm-hmm.
Okay. So again, you focus on improving flow, improving material flow, improving the quality of the materials. And as a result, you will reduce the quantity. And so again, price times quantity.
Yep.
There's also a final, anything else you wanted to add, Mike, before I move on?
Well, just quickly, for folks who are in different industries, sometimes the word scrap doesn't necessarily immediately translate, but think about anything that's going to expire or outdate or go bad, medical supplies, food, anything that is wasted. We can consider it's not simply the scrap in sheet metal that isn't used because of the way we're punching that piece of sheet metal. And any number of things that is wasted as basically scrap or discarded can be reduced as quality improves.
Yeah. And the final piece of material cost, there's the more material you have on hand, the more transactions you have. If you're in manufacturing, you might be doing cycle counting of inventory. You might even do that in healthcare. You have material handling expense. And then you have all the activities associated with missing parts, the safaris to go find supplies and parts. So there's a lot of sort of people cost.
Mm-hmm.
Okay, and all these activities are not value added.
Yeah.
And so, how many people do you have in quote unquote material management?
Mm-hmm.
There's opportunities there. All right, so let's wrap up. And again, Mike and I will talk about this together, sort of some practical advice. Okay, avoid, when you're looking at costs or cost management, you want to avoid using rates, allocations, or standards to analyze costs. As Mike talked about, monetizing time savings to calculate cost savings, try to avoid that. And these are things that, if you're a financial leader, you can have a great influence on these analytical practices.
Mm-hmm.
Differentiate between cost savings and cost avoidance. Understand and differentiate between fixed and variable costs based on the actual relationships, the cost relationship with sales, and not any kind of allocation system. Measure properly. We're talking about long-term cost reduction. We're not talking about short-term savings. And more importantly, it's cause and effect. Cost reduction is an outcome of the proper application of lean thinking. Value stream income statements. They're designed to meet the needs of internal users. They establish the clear relationships and linkage between financial outcomes and operating performance. And they create a whole lot of teamwork between finance and operations, okay? And I think this is one of the benefits I've seen with value stream income statements is working together. I know, Mike, you have some stories about this from your experience, right?
Yeah, and there was one article, it's actually the article that we just published in the Lean Accounting newsletter as a summary of what one organization has done with a lot of these lean accounting practices, but there's a little bit in there about the managing costs with a value stream income statement. And I think what this organization has learned, which is a very common story, is that by changing the presentation and the clarity and usability of the financial information, the leaders of different areas are able to understand and take action, but because they've gotten insights that they didn't have before. So it actually generates a lot more constructive action to improve and reduce costs and improve financial performance that simply they were invisible before because of the way that we present the financial information. So I think that's a big aha that hopefully you'll get as you move in this direction.
Yeah. And so as we wrap up, here are links. We have a Lean Accounting community chat this Thursday, free to attend. And you register once and you can attend any of them. They're always the Thursday after the webinar. And then we have webinars coming up the second Tuesday of the month. These have been scheduled and you can register for them right now. And we'll be adding more webinars as we go along. There is one good observation in the question, and it's from Donna, and it's about healthcare, and I'll sort of read it. And she makes some really good points. You know, in healthcare, it's a challenging task to capture cost avoidance and savings. You know, she points out the fact that you don't want to double dip in terms of, you know, counting something twice. And she uses the example of reducing falls. You know, that if you reduce the number of patient falls, you free up some time, but you know, it also improves patient satisfaction, length of stay, and there's lots of other benefits of reducing falls. So that was a really good point from Donna. Does anybody else have any final questions? All right, Mike, do you have any final comments?
No, I appreciated that note from Donna, and I would just, you know, as part of that, encourage folks to think about as they're doing financial reporting, to say, how does this really connect with how we're improving value for the customer? So to Donna, hopefully to your point, if you're improving quality and reducing patient falls, then the quality is improved, which is what the patient values, and we accrue financial benefits as well. But we're doing it to improve quality for the patient. We're doing it to improve end customer quality. That's what the lean strategy is all about. And we do have to be intentional about identifying what are the financial benefits. Yes, length of stay will go down. You might reduce sitter expense because your process has gotten so much better that you don't need folks monitoring patients who are at risk of falls. And there are any number of things, but the point is to improve the quality for the end customer, and then to be diligent about understanding the financial impacts and being strategic about saying, how do we redeploy that capacity that we've created?
Yeah, great. All right, so everyone, thanks for attending.
Thank you.
When we close the webinar, you'll get a link or an automatic pop-up to do the survey. Please complete the survey. And we hope to see you on the other webinars and in the community chat. If between now and Thursday you think of some questions regarding cost management, please join the community chat. We can have some extended conversations about that. So all of you have a good day, and we hope to see you soon. Bye-bye.
Yep, thank you.